How's it going, guys? All right, today I'm going to talk to you about TSP, 401k, whatever IRA, whatever your nest eggs are, withdrawal strategy during retirement. What I would recommend you do. The age-old wisdom is basically like the 4% rule. All right, so how do you figure out 4%? It's pretty easy. Just divide your account balance by 300. I'm actually prescribed to the 5% rule though, and then make adjustments at regular intervals. So the cookie cut stuff that you usually will get taught, like 4%, is it's assumed where the amount that you withdraw won't change at all over time. It's just always the same amount. But the way I recommend is to divide your balance by 240. That's a 5% rule, because 240 represents 20 years. And 1 year out of 20 years is 5%. All right, so that's where that comes from. And if you want to do 300, the 4% rate, that's basically a 25-year plan. All right. All right. So how this works though is, it's real simple. Just divide your account balance by 240. Whatever that result is, limit your withdrawals to that amount. Now, if you're dealing with a traditional account though, like traditional TSP or traditional 401k, traditional IRA, whatever, I do actually recommend taking extra money out beyond that and putting it into like a taxable brokerage account or some other kind of investment vehicle that will not time bomb on you with required minimum distributions. As it is right now, once you reach age 73, there's a mandatory, you have to withdraw a minimum of a specific percent of your remaining balance during that next year. And and as you get progressively past age 73, every year past that, basically the percent that the amount of your balance that or a proportion of your balance that you will be required by law to withdrawal will get greater and greater as you get further out. So for that reason, I usually say if you can, try to pull extra out. Whatever's above that balance divided by 240. If you're taking anything extra out, take it instantly to another investment vehicle. Don't even touch it. Just put it in like a taxable brokerage account. If you're not sure what a taxable brokerage account is, it's like Robinhood, Schwab, E-Trade, Scott Trade, whatever, anywhere where you can do online stock trading, basically, and where you get taxed on any capital gains of anything you sell. All right, so that would be my advice. And as far as the invest, how aggressive or conservative to invest once you're retired or near retirement, this is another thing where I am personally at odds with what the age-old wisdom that professional advisors will tell you. And I'm going to explain why I don't agree with them, all right? First, don't worry about your proximity to retirement. That should have no bearing at all on how you invest. How you invest should first depend on how prepared is your account balance for your retirement needs. And then after you find that it's adequate for your needs, okay, then let's talk about whether an aggressive or a conservative strategy, a mix of some sort, is more up your alley. If you're a balance, and here's the problem here. It's the same reason why we don't favor target date funds, like the life cycle funds or L funds and TSP, for those of you guys who are my TSP followers. Stay away from those. Those are just target date funds. They automatically shift their mix from a very aggressive posture early in your career, and then as you get closer and closer to the target date, they get more and more conservative. Okay, only one problem with that. These funds, as well as these professional advisors, are making assumptions that you are contributing adequate amounts of your money to your account right from the get-go. Like at age 20 to 25, they're assuming that you're investing adequate amounts to the account. A lot of times that is not the case. Some of you guys are going to retire with not enough in your accounts to really sustain your retirement needs. And for you guys who are in that category, this is horrible, horrible advice. All right. They're going to set you up for failure because they're going to glide slope you, as they call it. They use glide slope strategy to where your growth rate in terms of proportion of percent performance is going to slow down over time, at least on paper. And when you don't, the idea on that is if your account balance is already adequate enough, where as it gets closer to your retirement and being adequate for your needs, it slows down because you're shifting more and more toward bonds. by then. But again, a lot of you guys are not meeting that category or that description there. So that's why I want you to focus instead on get your balance where it needs to be first. Stay focused on the stock funds, stock index funds. They have built-in diversification, so you're not going to have to worry about these funds going bankrupt like individual company stocks do. Now, and you can't invest in individual company stocks in your 401k accounts, right? That's where your taxable brokerage account comes into play. You want to invest specifically in Apple or SanDisk or whatever other company, Tesla. That's where you would be doing that. All right. So, but anyway, I'm going to get to just specifically showing you an illustration outlining whatever of the effects of doing the 200, divide your balance by 240, limit that amount to, limit your withdrawals to that amount every month. And then I will show you how a couple of different adjustment strategies as far as when to adjust the amount is concerned, when that can actually work for you. One of them will be anytime there's a down month, with the S&P 500 or actually the TSP C fund, which is the S&P 500, by the way. One of the first strategies I'm going to show you is whenever there's the price on 1 month ends lower than what the price was the end of the previous month, make an adjustment. Recalculate what's your new balance divided by 240, and then stay right there at that level until whatever that level is until the next time you see a down month, which could be the very next month. It could be several months later. But we'll get to that. That'll be the first strategy, okay? The second strategy I'm going to show you will be regardless of what goes on between up or down months, adjust every 12 months. So in this case, it's going to be every May, I believe it was. Yeah, every May, regardless. And it could be any month you choose. But if you just do it at a regular interval, this is just to kind of compare what back testing historical data here on the prices. Which one of these 100% C fund strategies with withdrawals will get you the better result? Okay, and all right, so let's get to that. All right, so here is our table we're going to be working with here. Just to give you a little breakdown here, we got all the TSP core fund prices over here historically from at the end of April 2012, going with the end of each month all the way until the end until the current end of April of the current year. Okay, now the next two columns here are the trend data, basically. Okay, so this one here just basically simply tells you that this month end higher or lower than that month. That's it. If it's higher, then you'll see up. If it's lower, you'll see down. It's that simple. And then this next column here tells you how many down months there are in any rolling 12-month period. So starting here with April of 2013, there were only 2 down months in that period there. Between April of 2012 and April of March. Well, yeah, I would say, of 2013, whatever. And then we'll see if we get progressively higher as we go. Got up to about 7 there in February of 2016. And then it came back down to all the way down to 1 and even spent like 4 months in a row where there was not one single down month at all in the last 12 months. That's a really nice run there. Okay, then it starts to go back up some in 2018. That was when we had a correction there. I get them mixed up which one that was. That might have been the one where there was a bit of a price bubble, if I remember correctly. There was one. There were several corrections I've seen over those years, and one particular one was because of what I viewed to be a price bubble that got popped, and then the price basically came back down to what I thought was a reasonable level for what earnings were there at the time. And then it followed the earnings data that I had more consistently from there. All right, and then moving on, we got up to about 5 here in 2020 during COVID-19, I would say, the early part of COVID-19, and then kind of hovered until 2021, early 2021, came back down, and then it got all the way up to where we had like 8 months out of 12, and 4 times in a 5-month span in 2022, where we had down months because of concerns there. And as we are now, we're working our way back down, and we've only had 2 down months in the last 12-month period as of today. And that was just in February and March of this year. Okay, so that's the basic rundown on that. Now let's go ahead and talk about these 2 different withdrawal strategies. All right, so these next two areas here, you're going to see the blue area and the I wouldn't call it peach. I don't know. It's not really pink per se, but it's in that direction, I guess. We'll call it pink. I don't know. All right. So the blue side is going to be if you make an adjustment to your, recalculate every time a month ends lower than the previous month. And, divide your balance by 240, whatever that comes out to, round it to the nearest $10 and stick with that every month until you see another down month and then adjust again. Okay, that's the first strategy. The second one over here in the pink is where it doesn't matter what you get for ups and downs. Just adjust at regular annual intervals. Yeah, no ifs, ands, or buts, regardless. Okay, and you're going to find actually that the results are not far off from each other, but it actually did, at least on paper, favor the making adjustments every time there's a down month than if you do it annually. Okay, so let's go ahead and get into that here. All right, we're going to start with an imaginary $600,000 starting balance during retirement. I figured that might be a kind of rough average neighborhood that kind of not too far off from what a lot of you guys might be at by the time you retire. A good number of you guys are retiring with more than that, but I know there's also a good number who are retiring or going to retire or are retired with less than that. So just shooting from the hip here, I'm going to guess that 600K might be a decent number here. All right, so the way this works, now I'm dividing this balance by the current share price, and that gives me how many shares are owned on paper, or in this example here. Okay, and then this will figure out the withdrawn amount, and as you see there, it comes out to $2,500 a month to start with. And all right, so the first time you get that $2,500, you're selling 143 shares to get that amount. And this is something else I want to be looking at here, okay? So you have a finite number of shares for the most part. If you're making moves, if you're moving your money around from fund to fund, there's a pretty good chance you're going to lose shares based on that because making bad moves, but there's also a chance you could increase your shares if you're making good, smarter swing trade type of moves, which are less common, right? So I don't really recommend doing that for most of you guys. If you have a pretty good idea what you're doing, then you know that that's the risk that you're going to take. And so be it. But I'm focusing this on those of you guys who are in the buy and hold crowd. All right, if you just stay put, then we'll just assume you're staying put. It doesn't matter what your mix is. Doesn't matter if it's a 100% C fund or 100% S fund, 100% I fund, or any kind of mix of them that stays about the same. Should be in the same ballpark, right? But all right, so we're selling 143.8 shares, and we end up with an ending balance of 597,500. Okay, after we've sold those shares, we now have 34,369.8948 shares left. So now we have that. Then the end of the next month, we have that number of shares, 34,369, multiplied by the new share price, which leaves us 561,700. All right, so that was a down month. So we're going to end up with a withdrawal amount of 2,340. So you're going to be withdrawing 160 less per month because of that. But not to fret, just go ahead and keep it like that. It only went for 5 months before you made another adjustment. And after that next adjustment, you're right back up to $2,490, only $10 off from what you originally did. Okay, then move on, keep going until the next down month in 2013, you're up to $2,790. So now you're up almost $300 a month just from TSP alone over what you originally started withdrawing with. And that's only barely over a year later. Okay, and then 2 more months later, now you're up to $2,830, $330 a month over what you originally were started out with. And January of 2014, less than 2 years later, after the start, now you're up to $3,050. That's over $500 a month more than what you originally were starting with, in less than 2 years' time. Keep working your way down, and then in July of 2014, just a little over 2 years out, you're at $3,260. And then 33.20, 34.40, 33.20 again after that another adjustment because a couple down months. And keep working away. Now in 2015, that's when I like to call it the energy market, the energy sector recession. It wasn't a secular recession. It was more just an energy sector recession in 2014 and 2015. That's mainly what was going on there. But everything was kind of flat. Overall, even and a lot of it was being weighted down by the energy sector, but that's beside the point here. Okay. Anyway, October of 2016, back to making another adjustment. Now we're up to 3380. Making another adjustment in 2018 when that correction comes, and we're at 4180. So now we're at like $1,600, almost $1,700 a month more in what, 6 years time than what you originally were pulling out when you first started doing this strategy. And then it would come down to 4060 the next month, but then we're back up 4090 down to 3770, and then back up to 4090 in 2019, 4320 in August of 2019, and up to 4700 in February of 2020. Okay, it's going back and forth here, but as you see there, we had several up months there that were stronger too. So by September of 2020, now you're up to 4820. We're getting close to double the amount withdrawn per month than what you started with. And look where your balance is at. It's up over $1 million. It's getting, again, your account balance is getting to almost double in just 8 years' time, even while you're making simultaneous withdrawals every single month on this example here. Okay, again, Justin down in October of 2020, and then January 2021 comes around. Guess what? Now you're literally more than double your original account balance, more than double your original withdrawal amount per month. 5260. That's something. Why would anyone complain about that? I don't know. It'd be great money for yourself or for your heirs, whatever you plan to do with your TSP or your 401ks. September 2021. Now we're up to 5980, and November 21, we're actually over 6,000 a month. Okay, we're getting back down to less than 5,000 here in 2022 during that period where we had those 8 months out of 12 that were down months. But we're still well above what you originally started out with, and we're back to more than double in December of 2022. So it didn't take long at all. Just 2 up months is all it took to get back to over 5,000, and then keep working your way up. In October 2024, now we're up to over 7,000 a month, and working our way back down to 6870. And then in February of 2026. You would have already seen a $2 million account balance in January, but because of a down month in February, it dropped back down to 1.983 million. And as of April, another up month, it's you would have been back over 2 million. So you would be finishing off you would be starting out at 2.065 million before you were withdrawing 7,820 out of the account. Now this is more than triple what your original withdrawal rate was as far as raw dollars and cents. $2,500 a month originally, and now in only 14 years, you're withdrawing more than triple what you originally were withdrawing. And on top of that, your account balance is also more than triple what you originally started out with, in spite of no new contributions, and you're always pulling money every single month at a 5% annual average burn rate. Okay, that's something to be very happy about. If you guys are wanting to be aggressive and go for that, have that. These are stock index funds. Their value is not going to dwindle down to zero. Now, I would be ready for your balance to drop to about half of its value if a recession comes, and there is a concern about what a member actually asked about yesterday in the QOD post about sequence of returns. Now, sequence of returns, what that entails is basically if you start withdrawing, and then let's just say you stay aggressively invested in stocks when you retire and then starting to withdraw. If you have a large drop in share prices very early in your retirement, it has a much more negative impact on your long-term account performance potential than if that same problem comes, let's say, a decade later, or 15 years later, or 20 years later. Okay, when it's later on and when you've had plenty of time for it to just keep accruing more and more growth, then it's not so painful. But you don't want to end up in what I like to call a financial death spiral. I've personally had to deal with that myself with a mistake I've made in the past. And so I'll explain this just a little bit here for you. A financial death spiral is basically like every time the market drops and you're still, let's say, rigid about, I'm taking this amount out per year. Let's just say $3,000 a year, per month, I mean. That's $36,000 per year. So that $600,000 initial balance, then if you're, let's just say, accruing about 10% interest per year, then you're gaining about $60,000 in a year, but you're taking out $36,000. So your account balance is going up by $24,000 ish, roughly. Even with you withdrawing. But if you have a big down period there, then let's just say your account balance drops to 360,000. Then now you're basically tit for tat there. You're pulling 36,000 a year, and your account balance is only able to replenish 36,000 in accrued interest at the same time. So you're at that break-even point there, where if you have any chance in hell of getting out of that debt spiral at that point, that's the point where you absolutely have to start decreasing your withdrawal amount, or it's going to go into a death spiral. At that point, it's just a matter of time before you run out of money. Is it going to happen a year from then, 10 years from then, 20 years from then, 30 years from then? Who knows? But it will definitely run out by that point, at some point in time in the future, once you get past that point, if you don't make the proper adjustments. All right, now, let's just say you have a down period again, and now your account balance drops to 300,000. Well, now you're only gaining $30,000 a year at that 10% average rate, but you're pulling 36,000. So that first year, you're actually pulling 6,000 more than you're actually gaining back in interest. So it comes down to 294, and then it keeps coming down more and more as you get further and further distance between what you're actually pulling per year versus what your account can reasonably replenish through accrued interest. The faster it starts dropping, where it'll run out a lot more quickly as you get closer to a $0 account balance. I don't want to see you guys making that mistake. I don't want you guys to find out the hard way. You're going to have to go back to work, or some of you guys might, I hate to say it, do something drastic like suicide or murder-suicide, whatever it happens to end up being the case. That is something that, let's be honest here, people do in their lives over financial problems, and especially when you have no way to get money back. And, especially when you're of an age where you're not capable of working anymore, or even if you are, people don't want to hire you. What do you do then? You're going to have to do something, and you don't want to be in that position where now you have no way to support yourself unless you end up homeless, or, being supported by someone else, or I hate to say it, being ended. All right. So don't let yourself get into that financial death spiral, because some of you guys, if you end up in it, it's going to become a literal situation. I hate to say it. All right, moving on here, though, to the same thing, but if we're making annual adjustments instead of every time there's a down month. Okay, we're still starting out at 600,000. Now, generally, the account balance is going to stay roughly the same. Very similar for a good chunk of the way. We can look, compare this column to that column, and you'll see that it's generally staying fairly close the first few years. 2016, it's starting to pull away on the blue side, or the adjust during every down month strategy is starting to pull away just a little bit. Whatever the case, let's go ahead and just shorten this down and get down to the bottom of this. And we will see we have a ending balance of 2.041 million in April of 2026. Before you withdraw 8,500.0813, which leaves you with 2.033 million. All right, so your final balance here before your last withdrawal will actually be 24,000, almost 24,000 more using the adjust every down month strategy than if you just adjust and recalculate and adjust at a regular annual interval. Is basically what this is saying. Now, it can vary also based on what month you're making your adjustment. It's because when you're doing the annual thing, are you making an adjustment while you're in the middle of a bunch of down months, like right here where we have these 8, or is it making an adjustment somewhere else where there aren't so many? Okay, I did mention, I think in May or something, so there were at least in this situation there were a handful that were done, but and as we see here, making the same comparison where this down month was April 2022 on the annual schedule here, you would be withdrawing 55.62 per month, but on the adjust every down month, you'd be at 56.20. And then let me see. Oh no, this next one here. Okay, the annual thing here, you'd still be pulling 55.62 a month, but on the adjust every down month, strategy, you're down to 51.20 per month instead. And then next time you have another down month, then we'll adjust it. And as I said, these adjustments can come, and this actually aligns very well, correlates with what I've talked about to other people in the group, where now when it comes time to using this strategy, I just got this on paper to look at to prove that it actually is valid though. I always say, if the best withdrawal strategy is to let your money sit in the account as long as possible during bull market periods. As long as the prices keep going up and up and up, go as late as you can in the year before you withdraw any of it if you can. So like what Deb does, she just mentioned yesterday that she pulls all the money at in December, at the end of December, regardless. She doesn't do any monthly withdrawals prior to that. She just pulls everything at the end of December and then works off of it from there. That way, the share prices, assuming these are bull market periods, the share price is as high as it can possibly be, ideally, before any of that money gets pulled. And the higher the share price is, the fewer shares you have to sell to do it. Keep in mind you, while we're on that, good example here. When we're starting out here on this adjust every down month strategy, right at the very start, we only have a share price of 17,3844. And we're selling 143 plus shares to get that $2,500. Now, when we get further down where we are now pulling literally three times as much, look at this. We're pulling 3 times as much money out of the account, but we're only selling literally half as many shares as we did when we were pulling only a third as much money. So again, save, try to make adjustments as late as possible after up periods, and then during down periods, do it frequently. Make your adjustments every single month if there's a down period. That way, if it starts collapsing, let's say if you have a 50% drop, then you can also adjust your withdrawals accordingly, so you're not pulling so much, not pulling so many shares, and dwindling your share count down more quickly. All right. All right. That's all I have on this one here. This is just a kind of just basic, show you what my preferred strategy is. That's what I'm going to do myself once I'm ready to start living off my TSP as well. And what I recommend you do as well. As far as whether to be conservative or aggressive, that's your decision to make. You don't have to be conservative just because you're in retirement. There are plenty of people in the TSP group who are still 100% in stocks, still 100% behind either the Crown Tribe strategy or the Zane Train strategy, whichever, or maybe using their own like 100% C fund, perhaps. Now, for those of you guys who want to be a little more conservative, this is what we suggest. All right. So first, again, figure out what your balance divided by 240 is and compare that to what you actually need from TSP, all right? If this figure is not enough for your needs, you don't need to be talking about having a conservative mix at all. Keep it where it's at. Just stay aggressive in stocks until it gets to that balance where it actually can support your needs more effectively. Okay, then once you get it to a balance where it's, where that calculation is at a number that you think is sufficient, I can live with this amount, then all right, go ahead. And the simple thing here would be to ditch whatever and go to the 80% C fund, which is S&P 500, and 20% G fund, which is the U.S. Treasury index, basically. It only ever goes up, but at a slow, like roughly 4% rate. Well, the growth rate on G fund actually depends on what the average yields of all the bonds that are, all the Treasury notes that are outstanding that have at least 4 years remaining to maturity. So your 5-year, 7-year, 10-year, 20-year, and 30-year bonds are the only ones that factor into it. You can always get a basic idea on what those, what your rough average yield is going to be on that by looking at what the bond yields are of those particular bonds. It's usually going to be somewhere in the middle area. Not always though. When the yields are moving more quickly up or down, you're going to see it actually more toward one end or the other. Sometimes they've even seen where the actual growth rate is actually outside a little bit on either end. It doesn't tend to stray very far, but it does sometimes go outside that range before let's say the yields actually settle down and what's still outstanding catches back up, kind of reverts back toward the mean there. All right, and if you guys are wanting to go 100% G fund, I strongly discourage that. Now, there's only one reason why I would suggest that you would even think that should be a reasonable idea, and that would be if you have IRAs, other 401ks, taxable brokerage accounts, or other wealth assets of any kind that allow you to not need even a penny out of your TSP during retirement. If you have no need at all for your TSP, then by all means, go ahead, go 100% G fund, or if you're with your 401ks too. But if you can't say that you don't need a penny out of this particular account during retirement, then you should probably be at least 50% invested in stock funds, if not more. We usually say 80-20, but I will say sometimes if if you're definitely comfortable with what that balance divided by 240 figure comes out to, if that's definitely a comfortable amount for you during retirement, then maybe even 60% G fund and 40%, 60% C fund and 40% G fund. But generally 60 to 80% stayed in S&P 500 and 20 to 40% in the bond funds, or actually particularly the treasury yields. That would be the range that I would recommend here. If you're a little more questionable, but just enough, 80-20. If you're definitely comfortable, but you still want to, you still need or want to pull from it, maybe 60-40, but 80-20 is just fine too. All right. Or like you saw there, if you stay 100% in S&P 500 C fund, even if you lose half your balance there, let's just say now, if you started out with 600,000 and now you're up to 200 to over 2 million, then a 50% drop is still going to put you down at a tad over $1 million, which is still well over what you originally started withdrawing from, you started retired life with. All right. So don't be afraid to invest more aggressively if that's what you so desire. That's your choice to make, though. Don't make these decisions just because I'm suggesting it. You go with what is the right, what feels right for your own needs. But I do at least recommend calculate your balance divided by 240 and be sensible. Don't withdraw more per month than what that comes out to ideally. Okay, that'll be the best chance, or one of the better chances you'll have of making sure you don't ever run out of money, even if you decide to invest, to become more conservative with your investment stance. All right, that's all I got. Hope you guys got a lot of good info out of this. And some of this gets asked a lot, so that's why I'm covering it in here. And hopefully, a lot of you guys will actually catch this and learn some new stuff from it. Appreciate you guys watching. Hope you all have a great week, and all right, we'll see you guys on the next one.